What is the difference between cash accounting and accrual accounting? Don't switch off. Please don't switch off. This is a question that gets asked plenty of times because there is a box in the self-assessment tax return that asks the question whether you have used cash accounting to do your self-employment. Now, cash accounting is exactly what it says on the tin. It says you create your accounting records when you physically receive payment into your business for any income. It doesn't matter if it's received by PayPal, directly into a bank account, received physically in cash or cheque. It's when you've actually received the money. So, let's say, for example, you raise an invoice at the beginning of the term to Mr. and Mrs. Bly for their daughter's singing lessons, but you don't actually get paid it until near the end of the term. Annoying, I know. You would only account for that invoice when you received the money from Mr. and Mrs. Blythe. You don't account for the invoice when it's raised. Equally, on the other side, you only account for your costs when you have physically paid for them. Now that's very easy to do if you actually pay in cash or by direct debit or transfer out of your bank account, or indeed if you pay by PayPal, because they're fairly instant payment methods. The problem comes if you pay by credit card. Actually, you haven't paid for it until you pay the credit card bill. If you only pay a certain amount per month, it's very hard to know whether you've paid for that business expense. There are problems with cash accounting. You have to keep very good records to know when you have physically paid for things. But in your business, if you make a loss, then you cannot do anything with that loss. It could be your very first year in business. You've had a lot of setup costs and not many people know about you, so they haven't employed you very often. But that loss is dead. You cannot carry it forward to next year and use it against any profit in the following year. It also means if you've purchased any capital items, for example, a new instrument, a computer, an expensive printer, or various things like that, under the cash accounting rules, it's a cost incurred at the time because you've paid for it at that time, and therefore it goes into the accounts for that tax year. That means you cannot claim any capital allowances. All the costs come out of that year. So again, if you make a loss, you cannot carry that loss forward or carry the capital cost forward for another year. The only positive side of that is if you're buying an instrument on a loan agreement, then technically you're only putting towards, let's say, £100 a month instead of £3,000 in total. So that means you'll actually expense out £100 a month. As far as HMRC are concerned, they have two hats. They say you have to have the invoices and the receipts to do proper accounting. But then under Making Tax Digital rules, they're encouraging people to do their accounts from bank statements. So they want their cake and they want to eat it. Now, the other side of the coin is accrual accounting. This is the correct form of accounting that accountants will use all the time, and it's definitely our method of doing your accounts. When you raise the invoice to your customer or client, that is when it hits your accounts. So going back to Mr. and Mrs. Blythe, you have invoiced them, say, the beginning of term, which is January. They didn't pay it until April, so that's the end of the term. But you would have accounted for the income in January. But you can ignore it when they pay the bill. The problem comes in your mind if they pay for it in the next tax year, because you suddenly think, well, why should I account for that money if they haven't paid it? But the way it works is that unless they don't pay it, by the time you actually pay the tax bill, you would have paid the bill. Now, the good thing is that you base it on supplier invoice date. Even though you might not pay it until 2 weeks later, 6 months later, a month later, you account for it at the time you incur the cost, at the time the liability hits you, really. There are various accounting rules we can juggle with. So if you've taken a deposit up front for something, say for a concert, but the concert's not until 4 months' time, then you can defer that income until 4 months' time. So in order you match income with the costs. Now that gets a bit complicated, but that's what accountants do, that's what we're trained for. So there are good things with this accrual accounting, and one of the main things is you can carry forward any losses you have incurred, but also you can claim capital allowances. So that's the preferred method of spreading the cost of your expensive purchase over the life of the asset. Now, if you're a limited company, and that's how you prefer to do your accounts through a limited company, the cash accounting system is not open to you. You can do a cash accounting for VAT, but that's a separate item and a separate blog post. But actually you have to run your accounts and your corporation tax on an accruals basis, not cash. Many people do run it on a cash accounting because they don't understand the difference. So directors that own a company, they'll do cash accounting throughout the year, but then their accountant has to make good and make it under the accrual basis. So cash accounting is really only open to the self-employed. So that's it. Don't tick the cash basis box on the self-assessment tax return unless you are really sure what you're doing and you understand the implications, as it may cause problems later on down the line. Any problems? Please feel free to call us.